What do Warren Buffett, Michael Burry, and Bill Ackman have in common now? They are buying shares, and with bet amounts larger than many might imagine. In this video, you will get to know the 6 companies that receive million-euro investments from these investors, all based on public documents that reveal where the largest funds are investing. But before we begin, remember to like the video and subscribe to the channel to help me bring more of this information to you. In the first quarter, Warren Buffett made a move that went unnoticed by most investors. He increased his exposure in Constellation Brands by 113%. To many, it seems just another beverage company. But Buffett sees much more than that. Constellation owns brands such as Corona, Modelo, and Pacifico, beverages that are present at family gatherings, dinners, and barbecues all over the world. But what really draws attention is the numbers behind the operation. The company's EBITDA margin is an impressive 38.8%. To put it into perspective, this is a level of profitability typical of large technology companies, not a producer of beers and spirits. And what about the multiple? It is being traded at an EV/EBITDA of only 11.4 and a PE of 14.5. In other words, for every euro of projected profit, the investor pays today only €14.50. This is rare for a business with this track record of performance. What track record? The average annual growth of earnings per share over the last 5 years has been 48.9%. Yes, you heard that right. While all eyes were on technology companies, Constellation has been quietly delivering growth and consistency. There is yet another point that Buffett values: resilience in any scenario. The company has high pricing power. Even in inflationary environments, it can adjust prices without losing customers. Moreover, it is strategically expanding into other growing trends in the global market. All of this makes Constellation a company with a strong brand, solid cash generation, and still undervalued in relation to what it delivers. But the most curious thing is that even with all this, the market still treats it like an ordinary consumer company. Buffett clearly thinks differently, and this was not the only surprising move he made this quarter. Another curious move by Buffett at the beginning of the year was the impressive increase of his position in Pool Corporation by 144%. Pool Corp is simply the largest distributor of supplies for swimming pools and outdoor leisure in the world. This includes everything from filters and heaters to garden furniture and water treatment chemicals. At first glance, the sector may seem mundane, but it is precisely here that the hidden value lies. This is a niche market with little competition and a highly predictable revenue profile. After all, those who have a swimming pool need to maintain its operation year after year, and few companies can meet this demand efficiently and at scale like Pool Corp. Buffett knows exactly what he is buying. The company has a return on equity, ROE, of 54.5%, which is quite rare. Free cash flow represents 9.2% of revenue and has remained solid. Moreover, earnings per share have grown, on average 15.4% per year over the last decade. This is not explosive growth, but it is consistent, and consistency for Buffett is everything. Of course, the price reflects this quality. The current price-to-earnings ratio is around 28.2, and the enterprise value to earnings, before interest, taxes, depreciation, and amortization, EV/EBITDA, is in the range of 20. But as Buffett himself often says, it is better to pay a high price for excellence than a low price for mediocrity. Pool Corp delivers exactly that: excellence in an ignored market. Few competitors, stable margins, and recurring demand form the tripod that makes this business highly resilient. And it is precisely this that attracts Buffett: simplicity, stability, and operational strength, without needing to reinvent the wheel. But while Buffett is betting on predictability, Michael Burry is doing something radically different. While Buffett bets on quiet stability, Michael Burry follows a completely opposite path. He has zeroed his entire portfolio and concentrated 100% of his capital in a single stock, Estée Lauder. This is a bold decision, even by his own standards, as he is known for predicting the housing crisis of 2008. But what lies behind this bet? Estee Lauder is a giant in the luxury cosmetics industry. Even facing recent difficulties, it still maintains an impressive gross margin of 73.9%. This margin indicates that customers buy more for the name than for the product itself. And even after a significant drop in profits, free cash flow has returned to positive territory, exceeding €1.4 billion in the last fiscal year. This shows that, despite the unfavorable scenario, the company still generates real money. Burry's thesis is simple. The market has overreacted in its punishment. The stock has suffered, but the core of the business remains intact. The brand has global appeal, especially in markets such as China and the Middle East, where demand for premium products is rebounding. The valuation is still high, with a current price-to-earnings ratio of 26.3 and a projection of 32.5. But these multiples already incorporate an expectation of recovery. And there is one signal that stands out beyond these. Over €8.7 million in purchases by company executives in recent months, with no sales recorded. For Burry, when managers put their own money on the line, something is about to happen. And while Burry bets on patience, Bill Ackman is capitalizing at full speed. Bill Ackman does not usually make timid bets. However, what he did this quarter exceeded all expectations. He allocated 18.5% of the Pershing Square portfolio to a single stock, the largest position in the fund's history. And that stock is Uber, the very same Uber that years ago was synonymous with losses and uncertainty. What changed? Everything. The company turned a corner. It shifted from a model of disordered growth to delivering profit. Real profit. In 2025, it reported €9,860 million in net income. It is no longer a promise of future profitability. It is a reality that has already been established. And even with this turnaround, the market still seems to have not recalibrated its perception. Uber is trading at a price-to-earnings ratio of only 15.5, a level typical for industrial companies, not for global platforms with high scalability. The revenue figures are also impressive. €44 billion, with 30% year-on-year growth. And most importantly, a net margin of 27.1%. A margin that is likely to grow as the cost base dilutes. Each additional euro of revenue contributes even more significantly to profit. For many analysts, Uber's current trajectory resembles that of Amazon between 2014 and 2016. When profits finally appeared, the market needed to reprice the stock. And quickly. Ackman seems to be anticipating exactly this. A multiple correction that is yet to occur. Of course, there are risks. Regulation, competition, macroeconomic sensitivity, but the capital structure, global presence, and platform model place Uber in a position that is difficult to challenge. It dominates an entire ecosystem of mobility and logistics, and that is precisely why Ackman's bet is so aggressive. He is not just buying a positive balance sheet. He is buying a new moment, a new phase. Yet, while some ride this operational wave, others prefer to seek value in what has been left behind. Mohnish Pabrai looks at a turbulent past with eyes trained for the future. In the first quarter of 2025, he allocated 24% of his entire portfolio to a single stock, Volaris, a company that many investors hardly remembered still existed. Volaris is a name in the offshore oil drilling sector, a segment that has undergone a true collapse in recent years. The company even filed for bankruptcy in 2020, was restructured, and is now returning to the market with a much more disciplined model. The return on invested capital is already positive, and the operational numbers show that the recovery is not just narrative. An EBITDA margin of 25% and solid net profit. Nevertheless, the stock continues to be traded at a price-to-earnings ratio of 8.5, as if the bankruptcy is still fresh in the balance sheets, and this is where Pabrai's thesis comes in. The company is generating cash, has cost control, and operates in a sector with cyclical demand, and that demand is returning. The prices of oil, both Brent and WTI, are holding at sustainable levels, favoring the reactivation of offshore fields, especially the more profitable ones. Furthermore, Volaris's capital expenditure for the coming quarters is low, which allows for quicker conversion of revenue into profit. The point of attention now lies in the consistency of the operational cash flow. If it continues to stabilize, a new pricing could happen abruptly. This type of stock is aimed at those who understand commodity cycles and recognize that at certain times the market simply forgets to reevaluate assets that have begun to generate value again. But what if the next opportunity target is not at the bottom of the ocean, but rather in the telecommunications networks? While some investors seek disruption, Howard Marks remains true to the principle of stability. In the first quarter of 2025, he made Nokia one of the largest new positions for Oaktree Capital, with 2.44% of the fund allocated to the company. This may seem surprising. After all, when was the last time you heard about Nokia? But that is precisely the point. Nokia does not need to attract attention to deliver results. It operates in a critical sector, telecommunications infrastructure, and does so with consistency. It is not a stock to generate headlines. It is a stock to generate cash flow. Over the past 5 years, earnings per share have grown, on average 19.6% per year. The company has negative net debt, meaning it has more cash than liabilities, and it continues to generate free cash flow with a margin of 9.3%. In terms of profitability, the margins may not seem impressive at first glance, EBITDA around 13.1%, but they are stable and predictable. The valuation is in line with what is expected for this type of asset. A price-to-earnings ratio of 21.5 and an enterprise value to EBITDA of 8.7. Nothing exaggerated, nothing depressed, just fair for a solid operation. Marx's thesis goes beyond the numbers. Nokia is positioned to capture value on two structural fronts: the global expansion of 5G and the strengthening of sovereign technological infrastructure, especially in Europe. With governments increasingly aware of external dependence on networks and connectivity, companies like Nokia become essential. This is the stock that acts as an anchor in a portfolio. It stabilizes the portfolio when everything around it wobbles. And looking at all these movements, one question arises: what exactly connects these seemingly different decisions? 6 investors, 6 companies, 6 distinct strategies, but with something in common. All the actions presented here share the same profile: high margins, solid cash generation, and a clear thesis of recovery or appreciation. Even in different sectors, the pattern repeats. These are companies that endure, adapt, and above all, continue to deliver value. The big insight: these investors do not spread capital out of fear. They concentrate it out of conviction. When the fundamentals are strong, excessive diversification ceases to be safety and becomes dilution of results. So the question for you is your portfolio aligned with this logic? Does it prioritize cash generation, consistent margins, and rational valuation? It is not about investing in the same companies. It is about adopting the mental process and applying the criteria behind each decision in your portfolio. If this type of direct and technical analysis makes sense to you, subscribe to the channel right now. Also, like this video so that I understand that I can bring more content like this. Use this information to refine your portfolio intelligently. In the end, investing well is not about following the majority. It is about understanding before acting. I will see you in the next video.